Well, it was another session for the record books as the Dow, Nasdaq, and S&P 500 spurted to new highs. It was a more compelling session than those slim gains for the major indices actually suggested. We had merger mania. The talk of the session, of course, was a rumor I mentioned to you on Friday night. Broadcom offering Qualcomm $70 a share in a potential $130 billion deal. Lots of media scuttlebutt also that Disney has been in talks with 21st Century Fox about buying most of the company's assets. Now, we've reached out to management of both companies, and right now we have no comment. The best performing sector by far was energy as crude broke out from last week, picking up on that momentum. This after major arrests in Saudi Arabia of 10 senior princes, including Prince Walid bin Talal, and dozens of ministers on charges of money laundering and corruption. Through it all, though, Saudi Arabia continues to express a desire to end the world's oil glut. So crude is at a multi-year high. West Texas Intermediate $57. However, the S&P oil index, the XLE, is still down almost 7% for the year. There are certainly some values in that sector. But speaking of values and value traps, it brings me to the anxiety for many investors out there, including many fence-sitters looking to buy stocks now. Should you buy stocks that are down, or should you chase the ones that are breaking out? I know a lot of people are afraid of buying at the top. Nobody wants to feel like a chump, as our pride and ego bruise pretty easily. Now, this actually happened to me earlier in the year when I asked my subscribers to buy Weight Watchers at $10 for an oversold bounce. It got to $14, so I cheered. 40% gain. Let's take profits, even though I could see that the fundamentals were rapidly improving. And I thought, well, I wait to get back in. I haven't. By the way, the stock is at $49 after the close, after they just released their earnings report. Here's the key to this dilemma of chasing stocks. Buy stocks where the underlying fundamentals are improving even faster than the share price. Now, there are a lot of ways to measure this, from peer reviews to market share gains, but you can also glance at next year's earnings estimates. I love doing this. As we exit earnings season, investors are now armed with a whole lot of fresh information. For instance, you know Apple's selling iPhones now like hotcakes around the world at sky-high prices. Even their tablet and iPad business rebounding. 3 months ago, Wall Street thought Apple would earn $10.67 next year. Now that number is $11.17, and I'm sure it's going to go even higher. I've got 3 names for you that I think you can chase based on fundamentals. I'll have them ready for you in the morning on my website, wstreet.com. Again, wstreet.com. Make your portfolio great again.